Welcome to the ASC 810 Consolidation Training Series from PNJ Group. This first section tackles the most fundamental question in group financial reporting. Why do we consolidate at all? By the end of this video, you will understand what consolidation does, why it exists, and the two distinct models that determine when it applies. By the end of this section, you will be able to define consolidation and explain what a controlling financial interest means. You will understand exactly what happens to the financial statements when a subsidiary is consolidated. You will be able to identify the central question that drives every consolidation decision. And you will know the two models a SC 810 provides, and in what order to apply them. Imagine you are a bank deciding whether to lend to a large corporation. The parent company hands you its standalone financials. You see one line on the balance sheet, investment in subsidiary. You see dividend income on the income statement. That's it. You have no idea what assets the subsidiary holds, what debts it carries, or what risks it is running. That is the problem consolidation was designed to solve. Without it, the financial statements of a group of companies would be incomplete and potentially misleading. Consolidation combines the financial statements of a parent and all its subsidiaries into a single set of statements, presenting the group as if it were one company. The parent's investment line disappears, replaced by the subsidiary's actual assets and liabilities. Internal transactions between group companies are eliminated, so only activity with the outside world appears in the consolidated statements. The result is a complete picture of the economic enterprise the parent controls. The balance sheet transformation is dramatic. On the standalone parent balance sheet, the subsidiary is just one number, the investment account. On the consolidated balance sheet, every asset and every liability of the subsidiary is laid out in full. Cash, receivables, inventory, property, debt, payables, all of it. The investment account is eliminated and replaced with this detail. And if the parent doesn't own 100%, the minority owner's stake appears in equity as non-controlling interest. The picture becomes complete. The income statement transformation is equally significant. On the standalone parent, the subsidiary's contribution is a single dividend income line, which only appears when the subsidiary declares a dividend. On the consolidated statements, every dollar of revenue the subsidiary earned and every expense it incurred flows through. Internal dividends disappear. Paying yourself a dividend does not create income for the group. And net income is split to show how much belongs to the parent's shareholders and how much belongs to the non-controlling owners. Every consolidation decision begins with one question. Does the reporting entity have a controlling financial interest in another entity? Control is not just about owning a majority of shares. It means having the power to direct what an entity does and being exposed to the variable results of that entity's performance. When the answer is yes, the controlled entity's financial statements are pulled in and presented as part of the group. When the answer is no, the investment stays off the consolidated statements. This single question drives everything in a SC 810. A SC 810 provides two completely separate frameworks for answering the control question, and which one you use depends on the nature of the entity you are evaluating. The voting interest entity model applies to ordinary corporations and partnerships where control is exercised through voting rights. The variable interest entity model applies to structures where voting rights don't accurately reflect who actually controls the entity or bears its risks. Here's the critical rule. You always check the VOE model first. If it applies, you stop. You only move to the VIE model if the entity fails the VOE test. The voting interest entity model is the more familiar of the two. It applies to ordinary companies where governance works as you would expect. Whoever controls the votes controls the company. The consolidation trigger is straightforward. Own more than 50% of the outstanding voting stock, directly or indirectly, and you consolidate. Majority ownership creates a presumption of control. There are a few narrow exceptions, which we will cover in Section 2. But for most corporations, majority ownership equals consolidation. The variable interest entity model was developed to address a specific problem. What happens when a company structures an entity so that voting rights tell you nothing about who really controls it or who really bears the risk? Think of a special purpose vehicle funded primarily by debt, with just enough equity to technically have shareholders who vote, but those shareholders bear almost no risk and have little real power. The VIE model looks past the voting structure to ask who actually has power over the entity's most important activities and who absorbs the gains and losses. That party, called the primary beneficiary, consolidates the VIE. The model selection sequence matters. You always start with the voting interest entity model. If the entity is a normal company and you own more than 50% of the voting stock, consolidate, you are done. If you don't have majority voting control, or if the entity shows signs that it might be a VIE, insufficient equity at risk, voting rights that don't match economic exposure, then you move to the VIE analysis. The two models are mutually exclusive. You apply one or the other, never both at once. Getting this sequence right is the foundation of every consolidation assessment. Here is what to take away from this section. Consolidation exists because standalone parent financials hide the full picture of a corporate group. The central question is always whether a controlling financial interest exists. A SC 810 answers that question through two distinct models. The voting interest entity model, which triggers on majority voting rights, and the variable interest entity model, which triggers on primary beneficiary status. You always apply the VOE model first. In the next two sections, we will go deep into each model, the rules, the exceptions, and the judgment calls that arise in practice. Thank you for completing this section on why consolidation matters. Thank you for watching. Subscribe for more training from PNJ Group.